Module 7 to 1 P/E ratio and market cycles. The P/E ratio can be a useful tool for identifying market cycles and investment opportunities. Here's how it can be applied in this context. Market cycle identification. The P/E ratio can provide insights into the overall valuation of the market and help identify different market cycles. High P/E ratios. During periods of high P/E ratios, the market is often considered overvalued or in a bullish phase. This suggests that investors are willing to pay a premium for stocks relative to their earnings. It may indicate a period of optimism and potentially higher market risk. Low P/E ratios. During periods of low P/E ratios, the market is often considered undervalued or in a bearish phase. This suggests that stocks are priced relatively lower compared to their earnings. It may indicate a period of pessimism or market downturn, potentially presenting buying opportunities for long-term investors. Investment opportunities. The P/E ratio can help identify investment opportunities by comparing a company's P/E ratio to historical averages, sector benchmarks, or market indices. Undervalued opportunities. A low P/E ratio relative to historical averages or industry peers may suggest that a company's stock is undervalued. It could indicate a potential investment opportunity, as the market may have priced the stock lower than its intrinsic value. However, further analysis is needed to ensure the company's fundamentals are sound. Growth opportunities. A high P/E ratio relative to historical averages or industry peers may indicate that the market has priced a company's stock at a premium due to expected growth prospects. This could be an opportunity if the company is positioned for strong growth and has a sustainable competitive advantage. However, it's important to assess the company's growth potential and market dynamics to avoid overpaying for future growth. Sector and market comparisons. Comparing the P/E ratios of different sectors or market indices can help identify relative valuation opportunities. Sector rotation. When certain sectors have significantly higher or lower P/E ratios compared to others, it may indicate a potential sector rotation opportunity. Investors may consider rotating their investments into sectors with relatively lower P/E ratios, as they may offer better value or growth prospects. Market comparisons. Comparing the P/E ratio of a specific company to the overall market P/E ratio can help evaluate whether the company is overvalued or undervalued relative to the broader market. This can provide insights into the company's relative attractiveness as an investment. It's important to note that the P/E ratio should not be the sole basis for investment decisions. It should be used in conjunction with other fundamental and technical analysis tools to assess a company's financial health. Growth prospects, competitive positioning, and industry dynamics. Additionally, market cycles and investment opportunities can be influenced by a multitude of factors, and it's important to consider the broader economic and geopolitical context when making investment decisions. The P/E ratio and market sentiment are closely intertwined, and understanding their relationship can provide insights into investor behavior and market dynamics. Here's how the P/E ratio and market sentiment are related. Investor expectations. The P/E ratio reflects investor expectations and sentiment regarding a company's future earnings potential. A high P/E ratio indicates that investors are willing to pay a premium for the company's earnings, suggesting positive sentiment and high growth expectations. Conversely, a low P/E ratio suggests lower investor expectations and potentially negative sentiment towards the company's future earnings prospects. Confidence and risk appetite. Market sentiment, which can be bullish or bearish, impacts investors' confidence and risk appetite. During periods of positive market sentiment, characterized by optimism and confidence, investors may be more willing to pay higher multiples for earnings, leading to higher P/E ratios. This is often seen in bull markets when investors exhibit a higher tolerance for risk and expect sustained growth. Market exuberance and overvaluation. When market sentiment becomes excessively positive or exuberant, it can drive P/E ratios to unusually high levels. This can be a sign of market overvaluation, where investors are willing to pay excessively high prices for companies relative to their earnings. Such situations can indicate potential risks of a market correction or bubble, as market sentiment may be detached from fundamental valuation metrics. Market fear and undervaluation. Conversely, during periods of negative market sentiment, such as economic downturns or market corrections, investors may become more risk-averse and cautious. This can lead to lower P/E ratios as investors demand higher earnings yields or lower prices for stocks. Market fear and negative sentiment can result in undervalued opportunities. As companies may be priced lower than their intrinsic value, momentum and herd behavior, market sentiment and P/E ratios can also be influenced by momentum and herd behavior. When a stock or sector experiences positive momentum, attracting a large number of investors, it can drive up P/E ratios due to increased demand and price appreciation. Similarly, negative momentum and herd behavior can lead to lower P/E ratios as investors sell off stocks, causing prices to decline. It's important to note that market sentiment can be influenced by various factors, including economic indicators, geopolitical events, corporate news, and investor psychology. While the P/E ratio provides a quantitative measure of sentiment, it should be analyzed alongside other qualitative and quantitative factors to gain a comprehensive understanding of market dynamics. Investors should exercise caution and not rely solely on market sentiment or P/E ratios when making investment decisions. Conducting thorough fundamental analysis, evaluating a company's financial health, and assessing its growth prospects are crucial for making well-informed investment choices.